Alright, what's up guys? This is Taylor with the weekly watch list video for the week of September 6th. So hopefully you're having a good long weekend. And of course the market is closed tomorrow for the holiday, so we are back to the grind on Tuesday. But yeah, hopefully you're having a good weekend. Hopefully your dog has gotten a couple of walks. But we'll jump in here guys. Take a look at a couple different things. I mean, the overall game plan right now is pretty straightforward. We are looking to short the bounces. So the selling pressure continued last week, and from my perspective, it's pretty much bounce or die this week. So I think if we can't get a big bounce going off of last week's lows, I think the bloodbath continues. So we'll jump in here, set the stage for the week ahead. But first, a quick update on the spreadsheet. So we closed 2 trades in the Mastery last week, and we opened up a little short ski in the S&Ps. So 2 losing trades last week. Shameful, I know. We had calls in Oxy, and we took those bad boys off for a 22% loss. So I'm cool with that. And we had some calls in UNG, natural gas, and we took those off for a 35% loss. So 2 losing trades. Good exits, though. Great entries. Right? They had good structure. They had our signals when we got long. Then things started to misbehave. So we cut them loose. Zero tolerance policy. And then we got short the S&Ps. So the good thing about keeping your losses small, if we can hit on the call credit spread here, so if the short works, that covers all the losses and puts us in the green for the month. And then of course looking for a few more trades. But that is what we got for now. We're short the SPX. And I did post an SPY call credit spread for those in the group with smaller accounts. So we're short the S&Ps. And as far as a scorecard here, guys, it all kind of points towards the Bears. The Bears have got control here, so scorecard for the week of September 6th. Points for the Bulls. And realistically, guys, I don't know if we want to look at this as a major point. Points for the Bulls would be things that we're looking at the market and saying, alright, things might be bullish here. We might want to get long and stay long. So I'm not too sure if that's a point for the Bulls from that perspective, but for what it's worth, we are a little bit oversold. So maybe, if anything, that points towards, some sort of bounce off of last week's lows. But I have a hard time seeing that becoming a bounce that actually makes us want to get long and stay long. So maybe a half a point there for the Bulls. And then, of course, for the Bears, 0.1 is just a structure of the market. And now we're getting to the point where it's a structure of your monthly chart, your weekly chart, your daily chart, down to something like a 5-minute chart. It's all pretty bearish here. All looks like path of least resistance is to the downside. Then, of course, the dollar continues to break out. So strength in the Dixie. Not so much good for your equities market. And then the junk bonds, HYG. They're looking like they're heading back towards the lows. So if you pull up a chart of HYG, if that goes back to the lows, there's a pretty good chance the overall market does pretty much the same thing. And then I think an interesting point here for the Bears. The monthly charts. Not so much on the SPX at this point, not yet. But for now, more so the monthly chart of the QQQ. Now listen guys, I'm not calling for a 2008 type of market. But I like to focus on, trend and structure and price action. So we are seeing a couple of things here on a monthly chart in the QQQ that are kind of similar to, pre-2008. So we'll kick things off here and take a look at that. So monthly chart, QQQ. And all I got on the chart right now is the 8 EMA, the blue moving average, and then the white moving average, of course, is the good old 21 EMA. So on the monthly chart at the moment, a couple of observations for you. First observation, the squeeze histogram has gone negative. Now that hasn't happened. Track the histogram here. The histogram hasn't gone negative since 2008. And before that, you weren't negative. We're running out of data here, but we're going all the way back to like 2002. So first negative monthly histogram since the 2008 financial crisis. That's a big time frame. Right? That's a big picture view on the market. That, from a momentum perspective, is starting to transition from bullish to bearish. So that's obviously a pretty big shift. Right? 2008, 2022, 14 years. It done been a while. So there's one observation. And then something that, let me grab this bad boy. So Sam Shames from the options room, and I know a lot of you guys enjoy his videos that he does on the Simpler channel on Fridays. He made a pretty good observation. Notice here how the 8 and the 21 EMA moving averages are crossing negatively, meaning the 8 EMA is now under the 21 EMA. That also hasn't happened since the 2008 financial crisis. There's your bearish moving average cross. 8 crosses under the 21 EMA. So for the first time since 2008, you've got the bearish cross on the moving averages, and you've got the negative histogram. It's the last time we saw this, guys. And what's interesting is, if you look at the market in, let's see, 2018, neither of these things happened during 2018. The 8 EMA stayed above the 21, and the histogram stayed positive. Then, of course, you had COVID, and even during COVID, the 8 stays above the 21, and the histogram stays positive. So I think a really big observation here. Again, it's a big time frame, and the thing about a monthly chart is it's going to take a long time to unfold. But I don't think these are things we should ignore. It's pretty obvious that daily charts look like shit. The weekly charts, they're pretty shitty. But now we're getting to a point where the monthly chart is showing us things we haven't seen since 2008. Negative histogram, negative moving average cross. I do think over the next handful of months, that could be something to pay attention to, guys. So, I think a pretty big observation. And then I think another interesting perspective. If I take the watch list here, right? So on this watch list we have the indices. You've got your S&Ps, your Qs, your IWM. You've got a few different sectors. Financials, industrials, technology, semiconductors. And then you got the big FANG stocks. Microsoft, Amazon, Google's, etc. So on this watch list, guys, we've got weekly, daily, 4-hour, 2-hour, 1-hour, 30-minute, 15-minute, 5-minute columns. And what this is tracking is whether or not we're trading above the 21 EMA on that given time frame. So kind of the basics of swing trading, or at least my approach. We are a bit more bullish if we're generally trading above the 21 EMA across all these time frames. And then, of course, we're a bit more so bearish if we're under the 21 EMA across those time frames. So in terms of, okay, what's trading under the weekly 21? It's basically everything except the volatility index, energy, and the dollar. And the utilities, but Amazon, Nvidia, Google, your big FANG stocks, they're under the weekly 21 EMA. With that being said, your weekly chart really can't have bullish trend or structure. The S&P's under the weekly 21, the QQQ, HYG. Okay, what about the daily 21? Well, pretty much everything is under the daily 21, except for energy, the volatility index, and the dollar. And you see this theme pretty much go across all the time frames. Everything's trading under the 4-hour 21. Right? And if we're above the 21, we'll have the little green 21 right there. So like the QQQ, under the weekly, under the daily, under the 4-hour, we're under the 21 EMA across every one of those time frames. Same thing for the HYG, same thing for your IWM, the S&Ps, industrials, XLK, the semiconductors. That all strikes me as pretty bearish, guys. Even a 15-minute chart. Tough to think the market can put in a short-term bottom and give us a little bit of a short squeeze if we can't even get above a 15-minute 21 EMA. So, interesting observation there, along with what we're seeing on the monthly charts. And again, I think it's all pretty straightforward. Heading into this week, it's pretty much bounce or die. And I would look for that bounce off of last week's lows. And I think the ultimate target here, let me load up the goods. Alright, there we go. The ultimate target initially, in terms of playing this move to the downside, is a move back down towards these lows. So the game plan is short the bounce, which of course we haven't really gotten too good of a bounce just yet. We got a little bounce on Friday, which we shorted into, but the overall game plan for now is short the bounce, with an initial target down here towards the recent lows. And I think we could go even lower. But as far as shorting the bounce, we took we'll take a little bit more. So let's call it a starter position. We got a call credit spread here on Friday on the S&P 500. So let me get the 50 SMA. 50 SMA will make this little bastard orange. Thicken it up a bit. There we go. Alright, so 50 SMA. So ideally, I think you want to be willing to short the market, potentially all the way up towards that daily 21. And remember, we are a little bit oversold. Now, oversold does not mean we have to bounce. But in terms of probabilities there's a pretty good chance we could potentially get back towards that 21 EMA. So I think you can short underneath it, but I think you want to short in a fashion where, say you put a short on Friday around that 50 SMA. Make sure you're comfortable taking a little bit of heat and potentially adding a bit more on your short up there at that 21 EMA. But on a Friday, you got the initial bounce into the 50. Not quite at the high of the day, but pretty damn close. We went on ahead and put on the short. So here's what we did. And again, the key is, okay, we think we're going back towards the lows. That's Snowflake. I need SPX. Right, so the thought process is eventually, between now and end of October, I don't think it'll take that long, but between now and the end of October, we are looking for a move back down towards the recent lows. So I'm trying to catch these bounces as an opportunity to get positioned for that move. But I think in terms of, okay, do we do put credit spreads? Do we do call credit spreads? I think the closer you are to that 21 EMA, the more aggressive your entry can be. I think the further away from that 21 EMA that you're getting short, you want to structure a trade where you can comfortably take a little bit of heat. So as far as taking a little bit of heat, for now, we're not doing out-the-money puts. We're not doing put credit spreads, put debit spreads. We'll definitely do those kinds of trades a little bit closer towards the 21 EMA. For now, we're doing the call credit spread. So we went with the October 21st expiration, 4100, 4125 call credit spread. So I'll show you that in the Analyze tab here. So I took that on 5 contracts. So 5 contracts basically puts the max loss at, come on Thinkorswim. We'll go to September 30th. So max loss on that trade is about $7,300. Realistically, we're going to cut this off on a big move above 4,100. So I'm really risking about $1,500 to potentially make closer to $5,000, with the max profit being $5,100. So a pretty good risk reward there, but again, if the market trades sideways for a week, I'm in pretty good shape. For all I care, we can trade under 4,100 and trade sideways all the way up until October. If you buy some Delta 20 out-the-money puts, that sideways price action is going to get a little bit painful. So that kind of puts us in a good position where, we can open up a short on the bounce on Friday, still lock in a good risk reward, but it gives us a lot of flexibility. Where now this coming week, if the market pukes it up, and come Friday we're actually back down at that low, we're going to be pretty close to max profit. But if we trade sideways, if we grind a little bit higher, even if we rally a good amount, we still got some flexibility with the call credit spread. So we did that on the SPX, and we did another one here on the SPY. For those in the mastery with smaller accounts. So took that with 1 contract. And that is the trade for now, guys. That is the trade for now. So we'll look to take profits back down here at the low. We'll look to add a little bit more of this short on any bounce towards that 21 EMA. So that's a core trade for now. Not a posted trade, but on my own. I've also got some puts here in Snowflake. So next couple of weeks, if I can catch Snow down towards 150-ish, that'll be about a $10,000 profit. So I'm risking $5,000. I'll show you that position right here. October 21st, 150 puts. I bought the bad boys at, I think, $5. Yeah, 10 contracts at $5. It's going for about $730. So up about 40-50% on the trade so far. And I'm buying those puts back up here. So yeah, down at 150, I'll be up about 10,000. Down at 140, about 15. And then if we can get a big old flusher to 130, that'll be a nice $20,000 trade. So I'm short Snow personally. We're short the S&Ps in the Mastery. Oh yeah, and I also did the, I don't do this often, but I did the same exact trade in the options room as well. So we are short the S&Ps in the Mastery and in the options room. And frankly, guys, it's kind of all I'm seeing for now. Keep in mind, you could short the bounce on Amazon, and there's a lot of structure that kind of suggests shorting the bounce on Amazon is a good idea. It's basically the same trade. Meaning, if the S&P and the QQQ hit the lows over the next 4 weeks, Amazon, Apple, Google, Nvidia, semiconductors, financials, pretty much everything should roll over along with the market. So make sure you're a little bit careful, because you can get in a position where you're short Nvidia, AMD, Google, Apple, QQQ. They're all going to move together. It's kind of the same trade. So nothing wrong with shorting the stocks. But I think if you can short the S&P or the QQQ, pretty much covers all your bases. So that is the game plan for the short side. And then really, guys, as far as looking to get long, the only things that might potentially offer us some opportunity to the upside, I think at this point might be energy and maybe natural gas. So for UNG here, like I mentioned, we got rid of our calls on Friday. Now, the daily chart didn't get destroyed. We did end up actually closing right near that 21 EMA, and we've actually still got the big three buy signals here on the daily chart. Green label, green arrow. So everything looks pretty solid here from a daily charts perspective. Check it out from a multi-time frame point of view. On the 195 minute, we're under the 21 EMA. On the 2-hour chart, we're under the 21 EMA. We're under the 21 on the hourly, under the 21 on the 30, on the 15 minute, and we're above the 21 EMA on the 5 and the 1 hour, the 1 minute. So in terms of something being, as bullish as possible, like just fully locked and loaded for a big rip, the best score it could get would be 1, 2, 3, 4. The best score this could get would be 8. All 8 of these different time frames trading above the 21 EMA. All right, so if 8 is really bullish, let's grade out UNG. We're nominally above the daily 21. So there's 1 point. Under 195, under the 2, under the 1, under the 30 minute. So we got 3 points here. We're above the daily. We're above the 5. We're above the 1. Though UNG looks good from a daily charts perspective, this is not fully locked and loaded under the surface. So if you're long UNG right now, like we're looking for a move like that. Just a big-ass rip off of that 21 EMA. What that requires is good bullish trend and structure on all of your lower time frames. Right? Your lower time frames are basically the firecracker that can trigger that bigger picture move. So this would be an 8, right? In terms of you're above your daily, your 195, you're above that 21 EMA across the board. Right now, UNG only grades out at a 3. So before I could buy some calls here, even with a daily buy signal, I would at least want to see my hourly chart showing me some bullish action, trending back above the hourly 21. Otherwise, this is where these lower time frames can turn into a problem. Right? Where you get something like Nvidia, for example, where you're hanging out above that 21 EMA on your daily chart. Right? You're getting ready for a big rip, and then things totally fall apart. All right, so it's like, what happened back here? What happened back here and back there to trigger the big push off the mean? And then what happens over here to trigger the big breakdown? What happens is basically the stock begins to die from the inside out. The 1 minute chart goes to crap, the 5 minute, the 30 minute, the 15, the 2 hour. That all kind of takes a toll on your daily structure. So for UNG, that was a major thought process as far as making a decision to cut the trade last week. Daily chart looks pretty good, but as we're trading at 1 point under that 21, with all that crap going on the lower time frames, not as clean as we're looking for. So maybe UNG shapes up here, and then I think energy. Be patient with this, be careful with this, because I wouldn't assume energy has to rally. That might have been the theme earlier in the year, S&P's in a downtrend, energy in an uptrend. Doesn't mean it has to be the case moving forward. So for XLE here, pretty good daily structure. You got one close under the mean, but on Friday you gap up and you close back above it. So pretty good daily structure. But then if you pull up XLE on the multi-time frame charts, let's grade this out. Right. 1 point for being above the daily 21, but we're under the 195. We're under the 2. We're under the 1 hour. We are under the... we're above the 30 minute. We'll say below the 15. So this gets what? 1, 2, 3 points. 3 lower time frames holding decent structure out of a possible 7. Not going to be enough to trigger that move. So say you're looking to get, XLE calls. I think some trend back above the hourly 21, pretty much like you had back here. That's a pretty good indication you could be onto something. From another perspective, the hourly charts, the 30-minute, 15-minute, 5-minute, they continue to break down here. It could all get a little bit messy. So patience to the upside, guys. I certainly think the easier trade for now is just trying to get some shorts on the bounces. So if anything's going to hold up, maybe it's energy. Maybe it's something like Oxy. But then on Oxy here, it's kind of the same thing. We're not even really above the daily 21. So no point there. No point here, no point here, no point here. From a daily chart down to a 1 minute, the only time frame trading above the 21 EMA for Oxy is the 1 minute chart. Kind of tough to want to get long as that's the case. Need a little bit more than that. So I do think the easier trade, at least for now, is trying to catch a bounce in the market and then looking to get short. In terms of, okay, well, can we get a bounce this week? I'm not too sure, guys. Oversold is not really enough to warrant the bounce on its own. So be a little bit careful. If we can bounce off of last week's lows, then maybe you get a shot to add some shorts here. If we can't find support at last week's lows, then I think down goes Frazier. So there you have it, guys. Pretty straightforward, right to the point. Short the bounces as long as the structure is looking how it is. So more points in the favor of the Bears. And we'll see what this week brings. But I hope you guys found this helpful. For those of you in the mastery, I did share the flexible grid in our chat this morning for the chart layout here if you want to check that out. And then for the rest of you, I will put the link in the description of this video for the 30-day trial to the mastery. $7 for 30 days. Come on over, guys. Hang out with us. Get some of these big 3 trade alerts. Trade live with us during the week. And I do think next couple of weeks here, got some pretty good opportunities lining up to make some good cash on the short side. But that's all I got for you guys for today. Hope you have a good rest of your long weekend. And I'll see you on Wednesday morning for some pre-market prep. Talk to you guys then.